Hello and welcome to our Q4 2021 update. My name is Jordan Gillis. I'm one of the partners here at Saltus, and I'm joined by Mike Stimson from our investment team, who's going to take us through the update today. First of all, a very happy new year to you. We hope you had a wonderful Christmas. We're going to be looking at just what was happening in markets prior to the Christmas period, really at the end of last year. Obviously, it feels like it's potentially getting a bit concerning again. You know, COVID is back, Omicron is here, and inflation seems to be running away with itself slightly, and people are getting a bit nervous. So Mike, do you want to just run us through, give us a sort of overview of what's been happening in markets and what has been going on in the last quarter of the year?
Sure. So overall, it was a good quarter for investors, with portfolios up between 1.5% and 5.5%, depending on your risk profile and strategy, which took your 2021 returns to between 4% and 20%. So it's been a good time to be invested. Having said all of that, there's certainly a lot going on. You mentioned Omicron. Sort of was very scary at the beginning of the last quarter. That's a story that seems to have peaked, and investors are now less worried about that as the virulence seems to be lower than previous variants, which is good news. Perhaps more importantly, there's been a change in tone from the central banks with increased hawkishness, and that's continued to accelerate through the end of last year, and that's definitely something to watch in 2022. A couple of other things that we should talk about. Inflation now feels like it's going to be higher for longer. We've seen the Federal Reserve retire the word transitory from its vocabulary, which is probably a good thing. And we think that while inflation is going to peak at sometime in the middle of this year, April, May perhaps, when it does come back down and settle, it will settle at higher levels than pre-COVID levels. So that's something to be aware of. A couple of other things in geopolitics. Midterm elections in the US in November, that could lead to some volatility, and Russia-Ukrainian tensions seem to be on the rise again. The final thing I guess I would mention is China. In Q4, there's the beginning of a concerted effort by the Chinese government to deflate the size and the reach of the property sector, but without blowing up the entire economy. And so that's going to be something else to watch.
Okay, so sounds like a bit of geopolitical risk is coming back, and China deflating. Midterm elections in the US coming. What are we concerned about volatility, and what did we do in portfolios?
I think it's been a theme through certainly the second half of last year for us to try and find more investments that can benefit from that volatility. And so late last year we added a holding in a new macro hedge fund called Erect Asian Macro Strategies. Again, these are people who trade interest rates and currencies and can make money from the volatility from some of the things that we're talking about. That was one new addition. We also took some profits in UK equities into strength at the end of the year. But generally, we felt the portfolios were pretty well set up in Q4, and there wasn't a huge amount of trading going on. Okay,
and so given the environment that you've described, apart from sort of adding a manager that's focused on volatility in particular, the question on lots of people's lips will be, is inflation a good or a bad thing? And there's lots of different views around that. What is our actual outlook going forward, and how do we feel the year's going to pan out, and what are our concerns and focus points?
Well, I think if you look at the context of where we are, so despite COVID, the last 2 years have actually been a really good time to be invested. And as we look out towards 2022, we think returns are going to be harder to come by. We still expect to make positive returns, but if you think about the environment we talked about before, lots of the returns that we've had have been supported by the emergency measures that central banks have had. As they turn more hawkish, as interest rates are likely to increase, that becomes a more difficult environment to make money. The starting point valuations for your traditional asset classes, for equities and bonds, at least at a headline level, remain pretty high. And so we expect nominal returns to be lower than they have been over the last couple of years. having said all of that, there are still pockets of value, particularly in the cyclical recovery focused companies. And so we continue to sit here with a glass half full mindset, but we expect returns to be lower than they have been over the last couple of years.
Okay, so muted but still positive is kind of where we expect to be in our for the upcoming year.
Yes, I would say cautiously optimistic rather than muted.
Cautiously optimistic, fantastic. Well, look, thanks so much for running us through that, Mike, and thank you so much for joining us, and we look forward to seeing you again at our next quarterly update.